Many traders seek to find the holy grail of all strategies, jumping from strategies month to no prevail. They constantly look for something that's going to give them faster profits and faster returns, to make them more consistent and or to make them more profitable. Some even go as far as looking for strategies that will make sure that they have a 90% win rate and make sure that they're winning more than they're losing. The big question today is there a strategy out there that exists, or do we need to be changing our perspective? So do you find yourself jumping from strategy to strategy, month in, month out, hoping that miraculously, if you find that strategy, you're going to start to be able to make profits? Well, if that's the case, we need to dig deeper today to find out if that's actually true and if there is a strategy out there that will help you to find those magical, mysterious, profitable, consistent trades without having to do, I guess, what the most profitable traders are already doing. Let's dig deeper and find this one out. Having an edge in trading means having a way to make more money than you lose over a certain number of trades. Will you make money on the next trade? No one can tell, and that's not what the edge is about. However, an edge almost guarantees money over a certain number of trades, a large sample. Here are some important considerations. An edge doesn't mean you have more winning trades than losing ones. In very simple terms, the edge you're going to have in your trading strategy is what will give you an advantage over all other traders out there who are representing the market. So here you can just see from this small example that even if you had the best strategy in the world, in theory, this is debunked because it doesn't matter whether you have the best strategy or not. It doesn't mean that necessarily you're going to make more profits. What we do need to factor in, though, as a trader is how many trades are we taking? Too many traders, unfortunately, get into the habit of executing a trade and relying on that trade to be the trade that kickstarts them off to a great start in the hopes that they're going to pass their challenges or verifications, build their small accounts or flip their accounts. But as you can see, again, just from this small example, it's not about your strategy in itself, it's the volume of trades that you are taking. And we're not talking about one trade, 10 trades, we're talking hundreds, if not thousands. Now, the problem is most traders never get to 1,000 trades because guess what? They're too busy changing strategies month to month. Another thing to consider is that having an edge doesn't necessarily mean that you're going to be winning every single trade. And this is a problem with most traders. They enter the markets, they find the holy grail of all patterns, and then they build so much hope surrounding the idea that the trade is going to win, and then it's almost impossible for them to lose because price is bouncing into a daily or 4-hourly resistance. It's been holding for the last 2 days, and now the previous candle just closed bearish, and there's such a high chance it's going to continue down. The problem is too many traders expect to win every trade and realize that losing, or fail to accept, shall we say, that losing is part of trading. This then leads them to get discouraged, and then what do? Jump from strategy to strategy. Your edge as a trader simply means just executing your trades over and over and over again, systematically, sticking to the plan over a large volume of trades. But the biggest question is, how do we guarantee our edge as a trader? A casino has a number of built-in advantages that ensure it, and not the players overall, will always come out a winner in the end. These advantages, known as the house edge, represent the average gross profit the casino expects to make from each game. The longer you play, the greater the odds are that the results of your play will match up with the house edge and that you will lose money. The house edge varies significantly among the different casino games, with blackjack the lowest and keno the highest. Now, the big question is, have you ever heard of a casino going out of business? Did you notice here that the casino's edge relies on the players spending lots of time in the casino and then ultimately matching the casino's edge and losing money? Now, anyone can go into a casino and take $50 and put it on zero and win and walk away. Now, of course, this is where the casino will lose money. However, the casino is not set up that way. What the casino does is they make the environment very friendly. They make it exciting. They offer you food and drink, in most cases for free, so that you stick around. The more footfall that comes through that casino and the longer they can keep you in there, the likelihood is their guarantee of making profits is very, very high. The house edge, the odds advantage in its favor, represents the average gross profit the casino can reliably expect to make from each game. On the games with the lowest house edge, the smallest advantage, a casino might only be generating about 1 to 2% profit. On other games, it may make profits of up to 15 to 25% or more. The house edge on a double zero roulette wheel is 5.26%. For every 1 million that bets at the roulette table in a casino, the management expects to pocket a profit of slightly more than 50,000. The other approximately 950,000 is returned to the bettors. The casino isn't aiming to bankrupt a player in one sitting. It just wants to make sure that in the long run, the players walk out with a little less money than they came in with, leaving money in the casino's pocket. So the casinos, you can see here, really have it going for themselves. In most cases, if people walk into the casino and start betting, they can profit from anywhere to 1 to 2% in most instances, and in some instances, from 15 to 25% upwards. Now, notice here, there's no greed factor. It is what it is. They already calculate their edge based on a figurative number, as we can see in this example of 1 million. If they make a return of 5%, then they pocket 50,000, and they're still happy to pass back to the players 950,000 to ensure that they're not bankrupt and that they make a little bit of money, and of course, hope that they return back. Now, notice this is over X amount of money being invested into the casino or spent in the casino by the gamblers. This is not predicated on returns in a daily basis, weekly basis, or even monthly basis. They're prepared to pay out whatever they have to pay out and or receive whatever they have to receive until they've hit that figurative number of 1 million. And then they make their returns of 5%, which is equaling 50,000. Notice they're happy to give back profits to the customers so that they can return, meaning that the profits they give back in the short run could be losses to the casino, but in the long run, that's where they make their money. So the big question is, how do we summarize this in terms of our edge as a trader? Can we take away key points here that can help us to find our edge as a trader? Well, let's continue to understand what is happening here. So if we're going to use a casino as an example to liken it to us as traders, how does that translate? Well, that's us executing 100 trades, no matter what, making sure that we have enough volume of trades to give us an illustration or at least a clear identifier mark of where we're at in terms of our results. Not just one trade or 10 trades. That's us sticking to the risk that we pre-planned and not deviating from it. There's also us holding our trades and not closing them early or tampering with them or trying to get bigger risk to reward when the scenarios don't exist or develop or produce an opportunity for us. To basically sum this up, we need to be disciplined. But surely, is this all we have to talk about today? Risk to reward. The ratio can be considered as a benchmark or a measure when traders deal with individual trades. The best techniques to use the risk to reward strategy will vary from trade to trade, and thus strategy varies accordingly. It is generally observed that strategists prevailing in the market generally look for a 1 to 3 risk reward ratio for their investments. This means that there are 3 units of return generated when the trader takes every 1 unit of the risk. It generally gives protection to traders to manage their risk of losing money in the market. Even if the win rate is below 50%, every trader is bound to lose money in the market. Comparing the stop loss and take profit gives us a measure of the ratio of profit to loss or risk to reward. Investors use the risk to reward ratio to help them keep the loss to bare minimum and manage their investment with a focus of risk to reward perspective. So think about this. With a risk to reward ratio of 1 to 3, in theory, you only need to be right 30% of the time. And obviously, meaning you will be wrong 70% of the time to be a profitable and consistent trader. That means out of every 100 trades you take, you will lose 70 of them and win 30 of them. But with a risk to reward ratio of 1 to 3, you will ultimately at the end be plus 20R up over 100 trades. And this is your edge as a trader, risk to reward ratio. How many times have you been in trades where you tamper with it, you close it early, only to find that it pushes another 3, 4, 5R in your direction? I've done it many times. But if you think about how many times you've tampered with your trades, you've closed them early, if you were to do the opposite and have left them open, how much more profitable do you think you would have been? Furthermore, think about this. How much despair do you think you could have avoided if you just left them to run? I know I would on many occasions, because the result of tampering with your trades, not allowing your edge to work as it's supposed to, you find yourself doing silly things that you know you shouldn't be doing. So just like the casino, what can we learn? What can we learn as a trader from the examples that we've just spoken about in terms of your edge? Your edge is not defined by your strategy. The more patient you are, the more likely you are to get returns and make profits. Don't judge yourself by your last trades. I cannot stress this enough. Make sure that you're working towards 100 trades each time, identifying what is working, what is not working. Stick to your plan with your 1 to 3 risk reward ratio or whatever risk reward ratio you use, but don't tamper with your trades, because then you lose your edge. And remember, always be satisfied with your wins. Don't be greedy. If you lose, walk away, because your aim as a trader is to make sure you capitalize on the movements in the market enough times so that the edge can work in your favor. And ultimately, just like the casino, you'll either be making your 1 and 2% returns, and or in some instances, when the markets are really moving, you can make your 15 or 25% returns. It happens. Trust me, believe me. The only reason why it probably is not happening to you right now is because you're too busy interrupting your edge. So focus on it. Think about what we just spoke about. Is your risk reward ratio on your side? Is it working in your favor? Are you using it to your advantage? I don't know if you are, but if you're not, really think about what we spoke about today. I hope you enjoyed this video. I surely did. I was very, very happy to be able to deliver this to you today. But obviously, this is just my opinion. So let me know down in the comments what you think. And if you enjoyed this video, as I always say, please give it a thumbs up. Subscribe if you're new to the channel. Turn on notifications. And always, always trust the process.